Howdy, Jacob here. Today we're looking at ChampionX Corporation in the energy equipment and services industry. 6.6 billion market cap on 6.8 billion enterprise value. They provide chemistry solutions, artificial lift systems, and engineered equipment and technologies to oil and gas companies. Founded in 1882. Revenue looks very substantial. Huge increases 2020 through 2022 on the revenue side, but pretty cyclical as we see just in the last 8 years, minus 30% revenue and as high as 68% revenue growth. Gross margin somewhat consistent in the low 30s, operating margin a bit more inconsistent, as high as 13%, and then sometimes negative, but averaging out in the upper single digits. Recent return on invested capital looks really good with their high operating margin, but on average it's mid-single digits. With the balance sheet with 289 million cash on hand, 6 million short-term debt, 594 million long-term debt. So that 500 million long-term debt is really nothing. So we're pretty comfortable with that balance sheet, safe investment from that perspective. I do like that free cash flow is much more consistent than the earnings. Their depreciation and amortization more than offsets their capital expenditures. They definitely are increasing. So through acquisitions, a little bit of reinvestment for future growth, they do have increased capex, but their cash from operations is also increasing and at a very high rate as well. So great production of free cash flow. The majority of their cash is going towards share repurchases, maybe uh, maybe 50 over 50% of the last 2 years going to share repurchases, a little bit to debt reduction, and then the dividend of 1.1% pays out 68 million in aggregate versus 250 plus 5-year average free cash flow. So very reasonable payout. Let's start making our assumptions here on the revenue growth side. I mean, it is extraordinarily cyclical. I guess 313 margins. I love that free cash flow is higher again, but let's do maybe 7 and 9 with share change recently. 1% be about 66 million, 2% 130, 150 over here. So 150 would be 2% share repurchases. The dividend, they have a history of it. So not a big history of it, but I'll increase it with the revenue growth. And this is saying that the company uses about 50% free cash flow for share repurchases, at least average of the last 5 years. Again, it's been much higher recently, but um, based on the margins that we're projecting, let's say about almost 50% to share repurchases, maybe 25% to dividends, and then the rest to acquisitions and reinvestments. And we're saying the company's stock price needs to fall 66% before we get the return we're looking for here. So I will be waiting and looking at other companies in the meantime. But I hope you enjoy the video and have a great rest of your day. Thank you.